Ladies and gentlemen, welcome to Asian Guy Analysis on 24 January 2026. Something unusual is happening in the markets today. Not in stocks, not in crypto, but in assets people usually run to when fear quietly spreads. Gold has crossed $4,700 an ounce, a level few expected this soon. Silver did something even more shocking. It surged to an all-time high, rewriting price history in a single move. This is not random, and it's not hype. When gold and silver move together like this, it usually means one thing. Big money is getting nervous before the headlines fully catch up. Investors are not chasing profit right now. They're buying protection. Markets are sending a signal, and it's subtle but powerful. Risk is being priced differently. Confidence is thinning. Volatility is no longer just a possibility. It's becoming the baseline. Gold is not reacting to one event. Silver is not moving on speculation. This is a broader shift in behavior, a quiet rotation away from risk and toward assets that have survived every crisis before this one. The question is not why prices are rising today. The real question is what investors are preparing for next. And that's exactly what we're breaking down in this update. Today's move in precious metals is not just another price jump. It is a market signal. When gold and silver both push into record territory at the same time, markets are telling a deeper story about fear, caution, and changing priorities. Gold moving above $4,700 per ounce is not a normal daily fluctuation. This level reflects a sharp shift in investor behavior. Money is moving away from assets that depend on confidence and growth and toward assets that depend on trust and history. Gold does not promise growth, it promises survival. That distinction matters right now. Silver's move is just as important. Hitting an all-time high means demand has overwhelmed supply at every previous price level. This does not happen quietly. It happens when buyers are willing to pay any price to secure exposure. Silver often moves later than gold, but when it catches up, it usually does so aggressively. That is what markets are seeing today. What makes this moment different is timing. These record highs are not happening during a clear crisis headline. There is no single shock event driving panic. Instead, there is a buildup of pressure. Markets are reacting to uncertainty that feels broad, ongoing, and unresolved. Investors are not responding to one risk. They are responding to many small risks stacking on top of each other. Equity markets have already shown signs of stress. Volatility has increased, daily swings are becoming sharper, confidence-based trades are becoming harder to justify. In that environment, capital looks for places where risk feels limited. Gold and silver benefit directly from that mindset. Another key point is positioning. Large institutional investors do not move suddenly without preparation. When prices reach record levels, it suggests that positioning has been building for weeks or months. Today's move is not the beginning. It is the visible result of earlier decisions made quietly. Currency markets are also part of this picture. When confidence in future growth weakens, currencies can lose strength. That creates an additional tailwind for precious metals. Gold and silver are priced globally. When currency values feel uncertain, hard assets gain appeal as a neutral store of value. It is also important to understand that this rally is not driven by retail emotion. This is not social media speculation. This is not momentum chasing from short-term traders alone. The scale and speed of these moves point to institutional demand. Pension funds, hedge funds, and large asset managers tend to move early, not late. Their participation changes market structure. Silver's role deserves special attention here. Unlike gold, silver sits at the intersection of investment demand and industrial demand. It is both a safe asset and a working metal. When silver rises sharply, it often reflects concern about supply chains, production costs, and future availability. That adds another layer of meaning to today's price action. From a historical perspective, moments like this usually occur when markets are repricing risk. That does not always mean an immediate crash is coming, but it does mean expectations are changing. The future looks less predictable. When predictability falls, protection becomes more valuable. Another signal comes from volume. Record prices with strong participation suggest conviction. This is not thin trading. This is broad interest across regions and markets. Asian sessions, European sessions, and US sessions have all contributed to the move. That global participation strengthens the signal. In simple terms, gold and silver are acting like warning lights. They do not predict exact outcomes. They reflect mood. Right now, the mood is cautious. Investors are not optimistic enough to ignore risk, but not fearful enough to panic. That middle zone is where precious metals thrive. Today's market snapshot shows a clear theme. Safety is being priced higher. Stability is being valued more than speed. And assets that do not rely on promises or future earnings are gaining attention. This does not mean risk assets are finished. It means markets are adjusting their balance. When that happens, gold and silver often lead the conversation. That is why today's record levels matter. They are not just numbers on a chart. They are a reflection of how investors see the world right now, uncertain, fragile, and worth protecting against. Gold's move above $4,700 per ounce is not just a breakout. It is a statement from the market. This level marks a shift from cautious buying into confident positioning. Once gold crossed this threshold, it confirmed that buyers were willing to step in even at record prices. During today's session, spot gold traded firmly above $4,700 and at several points pushed closer to the $4,650 level. That matters because price behavior near record highs often reveals sentiment. Instead of sharp selling, gold showed resilience. Sellers were limited. Buyers stayed active. That balance suggests strength, not exhaustion. In normal conditions, record prices attract heavy profit-taking. Traders lock in gains, momentum slows, and prices pull back quickly. That did not happen in a meaningful way today. Instead, gold held its ground. This tells us that many participants are not trading for short-term profit. They are positioning for protection. Gold is often described as a hedge, but this term can be misleading. It does not hedge against one specific risk. It hedges against uncertainty itself. Right now, markets are struggling to price the future. Growth expectations are uneven. Confidence is fragile. In that environment, gold becomes attractive because it does not depend on forecasts. Another important factor is market structure. Futures markets and spot markets are both showing strength. When both move together, it signals alignment across different types of investors. Short-term traders, long-term holders, and institutions are not fighting each other. They are moving in the same direction. Analysts are now openly discussing $4,800 per ounce as a near-term target. That level is psychological as much as technical. Round numbers matter in markets. They attract attention, they shape expectations. When analysts start talking about them, it means sentiment has shifted upward. But this does not mean the path will be smooth. Even in strong trends, gold does not move in straight lines. Pullbacks are normal. Consolidation is healthy. What matters is how gold behaves during pauses. So far, dips are being bought. That pattern supports the idea that demand remains strong. Another layer to consider is timing. Gold's strength is coming during a period when other assets are struggling to find direction. Stocks are volatile, bonds are sensitive, currencies are reacting to every new signal. Gold, by contrast, is offering clarity. Its direction is clear, and that clarity itself attracts capital. Gold is also benefiting from diversification flows. Large portfolios cannot rely on one asset class. When uncertainty rises, managers rebalance. Even a small shift in allocation toward gold can have a large impact on price because supply does not expand quickly. It is also worth noting that gold is not reacting to emotion. There is no panic buying. This is controlled demand. Prices are rising steadily, not explosively. That kind of movement is often more sustainable. From a technical perspective, breaking and holding above $4,700 turns that level into support. Markets remember levels. If gold stays above it, confidence builds. That confidence then feeds into higher targets. In simple terms, gold's price action today shows strength, discipline, and conviction. Buyers are not rushing. Sellers are not dominating. The market is accepting higher prices as the new normal. That is why this move matters. Gold is not just reacting. It is leading. And when gold leads, markets usually listen. Silver's move today is more than just a strong rally. It is a historic moment. Prices pushed above $95 per ounce, reaching the highest level ever recorded. Unlike gold, which often moves steadily, silver tends to move in bursts. When it breaks records, it usually does so with force. That is exactly what the market is witnessing now. Silver is often called a hybrid metal. It sits between two worlds. One is investment demand, where it acts as a store of value during uncertainty. The other is industrial demand, where it is used in manufacturing, technology, and energy-related applications. When both sides of demand rise at the same time, silver prices can accelerate quickly. Today's record high suggests that this dual demand is fully active. Investors are buying silver for safety, just as they are buying gold. At the same time, expectations around future industrial usage remain strong. This combination tightens supply and increases competition among buyers. Another key factor is silver's smaller market size compared to gold. Silver markets are thinner. It takes less capital to move prices significantly. When institutional money starts flowing in, the impact is often dramatic. That is why silver tends to show sharper swings, both up and down. In this case, the move higher reflects conviction. Silver did not spike briefly and collapse. It pushed through resistance levels and held above them. That behavior suggests buyers are not just speculating, they are positioning. Historically, silver often lags gold in the early stages of a precious metals rally. Gold moves first, driven by fear and caution. Silver follows later, once confidence in the trend builds. When silver finally breaks out, it often signals that the move is broadening. That is an important message for the market. Volume also matters here. Strong participation across trading sessions points to global interest. This is not limited to one region or one type of investor. That kind of widespread demand reinforces the strength of the trend. Silver's volatility is another reason today's move stands out. In uncertain markets, volatility usually scares investors away. But when silver rises despite volatility, it means investors are willing to accept price swings in exchange for exposure. That willingness reflects rising concern about the stability of other assets. Supply dynamics add another layer. Silver production does not respond quickly to higher prices. Mining output takes time to adjust. When demand rises faster than supply, prices must rise to balance the market. Today's record level suggests that balance is being tested. Silver also benefits from relative value arguments. Compared to gold, some investors see silver as undervalued over long periods. When gold reaches record highs, attention often turns to silver as a secondary opportunity. That rotation can amplify moves once momentum starts. However, it is important to recognize the risks. Silver does not move in straight lines. Sharp rallies are often followed by pullbacks. Profit-taking can be sudden. Volatility cuts both ways. That is why silver is watched closely during record moves. How it behaves after the breakout will matter. For now, the message is clear. Silver is no longer on the sidelines. It has entered the spotlight. Its record high reflects a market that is looking for protection, but is also thinking ahead about supply, demand, and long-term uncertainty. In short, silver's surge is not an isolated event. It is part of a broader shift in market behavior. When silver moves like this, it usually means investors are not just worried about today. They are preparing for what comes next. The surge in gold and silver prices is being driven by a broad change in how investors are reading the global environment. This is not about excitement, it is about caution. Markets are slowly shifting from optimism toward risk awareness, and that shift is showing up clearly in precious metals. One of the main drivers is renewed concern around global trade tensions. When trade relationships feel unstable, long-term planning becomes difficult. Companies face uncertainty over supply chains, pricing, and demand. Investors struggle to estimate future earnings. In that kind of environment, assets tied closely to economic growth lose appeal, while assets built on preservation gain value. Currency behavior is another key factor. When confidence in growth weakens, currencies often become more volatile. That volatility pushes investors toward assets that sit outside the currency system. Gold and silver do not depend on the strength of any single economy. They are priced globally and trusted historically, which makes them attractive during uncertain periods. Interest rate expectations also play a major role. Markets are currently facing mixed signals about where rates may head next. When the outlook becomes unclear, non-yielding assets like gold and silver benefit. They are not competing with interest income. Their value comes from scarcity, stability, and long-term trust. Investor psychology ties all of this together. Markets move not just on facts, but on perception. When investors see gold holding record levels and silver breaking into new highs, it reinforces the idea that caution is justified. That perception attracts additional capital, which then strengthens the trend. It is important to understand that this does not mean a collapse is imminent. It means markets are adjusting, capital is being rebalanced. Investors are spreading risk rather than concentrating it. Precious metals tend to perform well during these transitions, when clarity is low and confidence is fragile. The key takeaway is simple but important. Gold and silver are rising because uncertainty is rising. These moves reflect preparation, not panic. As long as global risks remain unresolved and markets lack clear direction, precious metals are likely to stay in focus. This rally is not about fear of today. It is about protection for tomorrow.